Well, one of the difficult questions we're asking ourselves this year is just how much risk should we take in our bond portfolios? There's clearly some mixed signals in the market due to the cross currents that have formed over the last couple of months. On the positive side, you've got central bankers looking to extend the cycle, so they've become more dovish over the last couple of months, particularly in the US, so talking about scaling back policy normalization and rate hikes. They are looking to continue to support the market, and I think it's right to stay invested at the moment. There could be several quarters more of positive conditions for harvesting income from riskier credit assets and other riskier fixed income sectors. But against that positive backdrop, we have to recognize we're very late in the cycle. That brings with it lots of elevated volatility, lots of risks when we come to selecting corporates. And certainly when we think about making those allocations into riskier sectors, we need to be as flexible and very active, certainly as flexible as possible, looking across the broadest, I'd say a fully global opportunity set. So yes, I think it's right to be looking at taking portfolio risk in a positive way still, but we certainly want to be active, be global, and be very flexible. And I would certainly advocate throwing away any kind of benchmark, being very total return focused. Well, it's really interesting to see how the Fed has changed its language over the last couple of months. December was a big shift in policy direction from the Fed. We've had 2.5 years of interest rates rising slowly, and now the Fed is quite clearly on hold. They're talking about pausing any further normalization in rates. It's interesting to look at how the market's reacted to this. So as I look at forward prices for interest rates, the market's expecting the next move to be a rate cut. Now I can see why the Fed is on pause and is being more cautious. We are certainly past the peak of economic growth for this cycle. But to think there's going to be a rate cut as the next move, in my mind that signals a very strong conviction that there'll be a recession. That's what the market is predicting. Now I just don't believe this. I think that US growth coming off its peak and back towards trend is not a really negative signal. So I think the market has overshot. I actually think we will see another hike from the Fed eventually before this cycle is done. Whether that's at the end of this year is a timing question that I think will be clearer as the year unfolds. But we certainly at the moment are disagreeing with this view of the market on future rate cuts being the next move. Certainly one hike left in this cycle. Well, given our views on the credit cycle maturing and certainly being cautious when it comes to credit selection, we're not focusing a lot of our portfolio risk on that area currently. What we did see last year was certainly a big move in emerging markets. And they were punished, I think, for a number of reasons that all came at the same time. We had a very strong US dollar, we had rising US yields, we had a lot of geopolitical tensions as well, whether it was trade wars or oil prices collapsing. All of that was a perfect storm for emerging markets, and they did deliver very negative returns last year. But I look at this asset class, and fundamentally there are still some very positive signals there. In some of the biggest emerging market economies, we now have quite reformist-minded politicians and administrations that are looking to improve the fundamentals of these countries. So we've got a catalyst for positive change. We've got a lot of the macro headwinds from last year disappearing now. So if the Fed is on hold for an extended period, if there isn't any further dollar strength, if oil prices are recovering as they are at the moment, we've got the ingredients for quite a sharp potential rebound in sentiment towards emerging markets. And that could see some positive returns being generated. So at the moment, a lot of our portfolio risk is looking at investing in emerging markets in both hard currency sovereign bonds and also in local currency bonds and in the currencies themselves through the use of FX forwards. So that at the moment is around 30 to 40% of our portfolio risk budget. And I think that's a theme we'll be looking at a lot for this year. Well, fixed income is a strategic part of most investors' asset allocations. And the traditional benefits that we've seen from this asset class over the decades have been a stable source of income, relatively low drawdown and volatility compared to equities, assets like equities. And when we think about investing on a global basis, we get some added diversification benefits as well. So it's not just about looking at balancing returns and generating steady income, it's also about risk management. I think at the moment where we have asynchronized global growth, we have differences between the US and Europe, for example, and we have emerging markets on a very different trajectory. Looking at fixed income in a global way is a very interesting way to look at generating good returns for the risk that we're taking.
安聯投資